Good morning, ladies and gentlemen. It's great to be with you today, even though we are apart together. It's still a good experience. So my aim today is to give you a quick update of recent developments and specifically its implications for South Africa. So, I mean, listen, there's no point pretending otherwise. The world has changed since a major nuclear power invaded, that being Russia invaded Ukraine. So this has changed the world, and we have to acknowledge that. And we are going to have a quick look in this presentation, really like a little snapshot, running through the likely implications going forward. Now, of course, it's a very fragile situation. It can easily escalate. We have heard the speculation on virtually every news media you can think of what the potential implications of any escalation would be, from chemical weapons to nuclear power. But for now, the world seemed to have taken a sensible approach to this. They have opted to support Ukraine financially, economically, and of course, through military support as well. And at the same time, they have slammed unprecedented sanctions on Russia. Now, what this crisis and what this war presents, it's really inflicting on the world economy a commodity price shock, specifically an energy price shock. And this is so because Russia plays an outsized role in the global energy markets. It produces 12% of the world's oil, and it produces 18% of the world's gas, natural gas. So the bottom line is, that's what we're looking at. And predictably, we are seeing these price shocks coming through. Oil prices have skyrocketed, natural gas prices have soared, but because the war could potentially also disrupt trade links and the normal operation of global trade, and because we have seen sanctions on Russia's metal and agricultural exports, what we've seen is that this war has really driven all commodity prices higher. And you've seen particular strain and pressure in metal prices, and you've seen it in food prices. Now, among your food prices, the reason food prices have moved so dramatically and so sharply is because Russia and Ukraine combined make a significant contribution to global food production. There in that little table at the bottom, I show you their share of global world trade and certain food commodities. They produce 30% of the world's wheat, 17% of the world's maize, and over 50% of the world's sunflower seeds. So that's why you're seeing the pressure on food prices coming through. So clearly, you know, this shock is a commodity price shock. It's driving up essential commodities, particularly those sorts of things people can't avoid, that they have to spend money on, which is fuel and energy. And it is coming against the background of a world economy already grappling with high and persistent inflation. So what it's going to do is essentially it's going to aggravate those price pressures. We've already got a situation in most advanced countries where producer inflation, as you can see in this graph, is absolutely extraordinary, where producer inflation is over 10% in many rich countries, over 20% in the cases of some advanced countries. It's going to aggravate those price pressures even further. If it does disrupt trade links, if it does, it will add to supply chain constraints, and on top of that, many of those have not been resolved yet. The world is still dealing with a pandemic. It is still dealing with the disruptions associated with that, especially in the East. And especially given how China has been responding to COVID outbreaks with their zero-tolerance approach. So it's going to aggravate producer inflation, it's going to aggravate consumer inflation, which in advanced countries are already running at multiple decade highs. We've got US inflation at 7.9% for February. That was the outcome of that month's inflation number, which is a 4-decade high. So it's really extraordinary inflationary pressure that was already in the system before the war began. All right? And not only will it aggravate inflationary pressure in advanced countries, which it will also add to inflation in most of your major developing or emerging economies, where we've also seen price pressures start to rise. Now, what this actually means at the end of the day is you've got this price shock, but what we know is the nature of this price shock is such that it's got significant implications for global growth as well. We know that high and persistent global oil prices, tends to chip away at global growth. And that's the problem with this. What does oil prices do? Essentially, it undermines confidence, it raises the production cost for companies, it puts strain on disposable income of households, so it reduces the income available for them to spend on discretionary goods and services. And as a result, it kind of subdues overall global demand. So high and persistently high oil prices, sustained high oil prices, are exceptionally bad for global growth. It doesn't immediately bring the global economy to a halt, but over time it chips away at global growth. This shows you global growth in most of your major economies, and you can see we've had a robust rebound from the pandemic, or from the worst of the pandemic in 2020. A lot of that was driven initially by China's resilience, and then later on by momentum coming from your advanced countries, with, of course, the support of very strong and very stimulatory monetary and fiscal policy. Now, towards the end of last year, those monetary and fiscal policies were already starting to fall away. Fiscal policy had largely fallen away. That support was out of the system. And in many of your advanced countries, you've seen that they've started to normalize monetary policy already. And in many of your emerging markets, you've actually seen that they've tightened monetary policy quite considerably. So the outcome of this is obviously that we have seen growth rates moderate. And ultimately, that means that this shock now comes on top of a situation where global growth was already moderating to a large extent. And it's going to chip away at it even further. So this is a crisis where you've got both essentially high inflation and a threat or downside risk to global growth. It can weaken global growth. So this crisis, this war, introduces stagflation to the world economy. Now, stagflation is a particularly difficult and challenging economic phenomenon for central banks to deal with. The general wisdom out there is that it's probably best for them, or among central bankers, the general wisdom is that it's probably best for them to move in an incremental manner. In other words, to gradually raise interest rates without completely killing the economy. And in that way, they ensure that inflation expectations remain anchored and that inflation doesn't start to feed on itself and become entrenched. So what we're going to see is, and what we've already seen, is that in most emerging markets, they've tightened monetary policy quite significantly. And in most advanced countries, they've started to normalize. And we'll see that process continue. The US, which is the big one, they meet today and tomorrow, and they've already indicated they're going to stick to their plan. They're going to gradually raise their interest rates, which at the moment is at exceptionally low levels. They are also going to start to reduce their bloated balance sheet. And that's probably a sensible thing to do. Gradually increase your interest rates, get rid of excessive stimulus, start to reduce the balance sheet, but don't overreact to the situation. But what all of this means, the war, all the uncertainty around the war, essentially your situation with the US also tightening monetary policy within this context, the very uncertain global outlook as a result of this shock, all of this tends to support the dollar, all right? And the dollar's already run quite significantly. It's already strengthened quite significantly. And what does that mean for a country like South Africa? It simply means that that all emerging market currencies would tend to depreciate against the dollar. So there's that particular pressure. It introduces the concept of renewed currency vulnerability. At the same time, of course, South Africa's rand is exceptionally vulnerable to any changes in risk appetite. This graph shows you the relationship between our proxy for emerging market risk appetite and the rand, and you can see they tend to follow each other, all right? So the rand is very sensitive to abrupt changes in global risk appetite. The war, the commodity price shock, the surge in global oil prices, all of that tends to lean to a situation where you could see spikes in risk aversion. And you could see a situation where risk appetites could just evaporate and you could have a risk-off environment. And if that happens, the rand will come under sustained pressure. Now, at the moment, South Africa's rand has been remarkably stable. I mean, it's the most unpredictable currency out there. Who would have thought or expected this? But it's been remarkably stable. It's been supported, really, by the fact that we still have a trade surplus. It's been supported by the renewed momentum that we have seen in metal prices in particular, and also by an anticipation that the Reserve Bank's going to hike interest rates very aggressively. I have to say, I have my doubts about that. I question that assumption, but nonetheless, that is partly what's been contributing to the rand holding up so well. If we compare that to emerging market risk, which is the green line there, you can see the rand is trading more or less in line with emerging market risk. But once the war started, the rand's actually held up better than your emerging market risk appetite, which took a hit. And other emerging market currencies have not been as lucky as the rand. And that's that metal price effect, that counter force coming into play. But the rand is inherently vulnerable. And if it were to come under pressure, it would amplify inflationary pressures because you'll have then high global oil prices, you'll to have some extent upward pressure on food prices, and the rand will make all of that worse. We already have a situation in South Africa where inflation has moved higher. It's at 5.7% at its last reading, which is above the level the Reserve Bank targets. Remember, they explicitly target 4.5%. All the pressure in South Africa has come from goods inflation. And again, this environment, this global development, the war, the spike in global oil prices, all of that will add to goods inflation. And if it remains persistently high and it's combined with a weak rand, you could see inflation rising above 6% over the next couple of months. We do believe eventually global oil markets will adjust. Oil prices will start to come down. And with that, you should see South Africa's inflation rates start to come down towards the end of the year. But the point is, it's a very uncertain environment. There's huge upside risk to inflation. The Reserve Bank will, of course, consider this. They tend to be very hawkish. They tend to be very conservative. They tend to favor that notion of acting preemptively. And they also know that interest rates in South Africa is actually at the moment exceptionally low. And therefore, there's no buffer to compensate for changing risk appetites. And so as a result, we do believe they will continue to increase interest rates. They'll probably increase it, in our view, at every single meeting this year. We don't think they're going to be moving 50, 75, 100 basis points at a shot. That is really inherent in the FRA curve. That's what the market's anticipating, that at some of these meetings they'll be moving with more than 25 basis points. We don't anticipate that, but we think they will hike steadily and gradually at every meeting, taking interest rates up by 1.25% by the end of this year. So it takes your repo rate from 4% to 5.25%. And then we believe they'll continue to increase in the early part of next year. After that, though, we do think South Africa's demand environment will start to bring inflation under control. And thereafter, we don't think it's going to be so easy to justify continuing the tightening of monetary policy. So we see interest rates actually flatlining from that point and staying steady at that sort of level. Right, so what does all of this mean for growth? Well, we've got to wrap up really quickly, but what does it mean for growth? In South Africa, our recovery has been driven by a rebound in consumer spending. It's been driven by exports outpacing imports. That's what this graph shows you. Now, unfortunately, the war in Ukraine, the spike in oil prices and food prices, and the potential threat to the rand, all of that will impact on those two key drivers of our growth performance, which is consumer spending and exports minus imports. So let's first deal with exports. Now, exports, you've got two elements here. You've got volumes and you've got prices, right? Now, as far as exports volumes are concerned, as global growth slows, growth in our export volumes will slow. But we also think that the biggest damage to our export volumes will not be done by the global environment. It will be done by our own structural issues, notably electricity shortages, which just seems to get worse and worse every single year, all right? So that's the first thing to bear in mind. So export volumes will probably slow and may even contract at some point during the course of this year. But export prices are going to be more resilient than we initially thought. The war, the sanctions on Russia's metal exports are likely to keep export prices elevated and provide South Africa with a bit of an insulation from this global crisis and this war happening in Ukraine. But even so, the rise in oil prices and the fact that we are net importers of oil and refined petroleum will mean that imports will also escalate. And ultimately, we do think that imports will grow faster than exports, and that the benefit provided by our trade surplus over the past 2 years will start to fade. It's not going to disappear overnight. We believe the trade surplus will narrow slowly, and by the time we get to the end of this year, will turn negative. So that's how we view this picture play out. So it's going to be less of a boost to economic growth in the year ahead. So that means we have to rely on domestic demand. If it's not going to be net exports, it's got to be domestic demand. Now, there are positives and negatives for consumer spending. The negatives are obviously higher oil prices, potentially higher food prices, a weaker currency that will inflate all prices out there, and then obviously higher interest rates. The positives against that is that you could see a situation where you'll have renewed job creation. We are currently in a situation where we anticipate that, your labor-intensive industries, travel, tourism, hotels, restaurants, they will slowly and gradually start to recover, and as they do so, some jobs will be created. So that will provide a boost. Government still paying the SDR grant for another year will provide some protection, very little protection, but some protection to the lower and most vulnerable segments of our society. And on top of that, households have become net savers. So they've got a bit of a buffer. They can absorb some shocks and continue to spend. So we do think that consumer spending will continue to grow, but the rate of that growth will slow quite dramatically. We also think, encouragingly, that it will get some support from increased fixed investment. Now, at Nedbank, we put together something we call Nedbank's capital expenditure project listing, where we record, and have done so since 1994, all capital projects being undertaken out there in South Africa. And we are starting to see some signs of life on this category. We're seeing increased spending by government on water infrastructure and on road infrastructure. And it's not fireworks, but at least there is some sign of life. And we are also seeing, ultimately, we're going to see the renewable energy projects come on stream, and that's going to provide some support. So we're anticipating that fixed investment will turn the corner this year from exceptionally low levels. So that will provide an extra bit of support to the economy. So if we put it all together, what does it come to? There's a lot of downside risk. There are many moving parts. This thing could still turn ugly for South Africa. But because of the ripple effect through to metal prices and to our export prices, we are more insulated from the war in Ukraine and all the disruptions associated with sanctions on Russia than many other countries are. And so, therefore, we believe our recovery will continue, but it will slow. We're anticipating growth of 1.7% this year, 1.8% next year, and thereafter we expect it to revert back to trend. The real momentum is going to come from the consumer. The consumer will do the heavy lifting. They will do it at a much slower pace than they did last year, but they will do the heavy lifting. And there will be a little bit of an extra boost from increased fixed investment activity. So that's my story, and for now, folks, we're going to have to stick with it.